All right, let's get right into it. Looking at the board, Cleveland-Cliffs Inc., ticker CLF, is at $16.18. That is a massive move, up $2.86 or 21.47% today alone. This is an absolute explosion. Now, the immediate expectation, the gut reaction most people have when they see a stock like Cleveland-Cliffs go vertical is to think, it's just a fluke. They see this on their Robinhood app or their Fidelity mobile app and assume it's a temporary commodity spike, a short squeeze, or just noise in a notoriously volatile sector. The common belief is that steel is steel. It's a dirty, cyclical, old-world business, and this 21% jump is a signal to sell, not to buy. People practicing self-investing or those using broader intelligent portfolio services are probably seeing their materials allocation spike and getting nervous. But the reality of what's happening here is almost certainly something different. A 21% move in a single day for a company of this scale isn't just noise, it's a fundamental repricing. This isn't just a reaction to the spot price of steel, this is the market waking up to the fact that CLF has become something unique. This is what it looks like when a company transitions from being a simple price taker in a global market to a dominant, vertically integrated price maker in a protected domestic market. This isn't a fluke, it's a signal flare, and it suggests the old narrative about this company is completely broken. For years, the common ground for any investment discussion around steel was to avoid it. The sector was seen as high cost, under constant threat from cheap imports, and a dinosaur industry. You wouldn't find it highlighted in the same way as Tesla stock or Nvidia stock. Those are stories about the future. CLF, in most minds, was a story about the past. Most online investing guides would steer new investors toward tech or consumer goods, not blast furnaces. But today's 21% spike challenges that entire premise. What if the dinosaur is now the apex predator in its own ecosystem? The reality is that Cleveland-Cliffs, under its current leadership, has been on a multi-year campaign to consolidate the entire domestic supply chain. They bought AK Steel. They bought ArcelorMittal USA. They aren't just a steelmaker, they own the iron ore mines, the pelletizing plants, and the furnaces. This move today isn't just about steel, it's about control over the entire steelmaking process from the ground up. So let's break down this 21% surge. This is not retail traders pushing the stock. Look at the trading volume. It is multiples of its daily average. This is a massive wave of institutional buying. This is what happens when analysts at major funds, the ones managing Fidelity mutual funds or big Fidelity wealth management accounts, get a piece of news that forces them to rewrite their models from scratch. This is algorithms at firms that use interactive brokers firing off buy orders because their quantitative models just detected a profound shift in the sector's profitability. What kind of news does this? This is almost certainly tied to significant government action. Think major new tariffs, strict anti-dumping enforcement, or a sudden massive release of infrastructure contracts. When the government effectively walls off the domestic market, the company that owns the domestic supply chain suddenly has incredible pricing power. This move is also catching an enormous number of short sellers completely off guard. For months, hedge funds have likely been shorting CLF, betting on a global industrial slowdown and a collapse in steel prices. Today, that trade is blowing up in their faces. They are being forced to buy back shares at any price to close their positions, and that forced buying is pouring gasoline on the fire. This is a classic squeeze, but it's happening on top of a fundamental re-rating. It's a painful day for anyone who held that short position, perhaps using the advanced option strategies available on the Interactive Brokers platform. Meanwhile, the average person on SoFi Invest is just seeing a stock go parabolic and wondering why. This is the old economy striking back with a vengeance. We spend so much time talking about the the potential of AI driving Nvidia stock or the EV transition for Tesla stock that we forget that you still need steel to build the data centers, the charging stations, and the car bodies. CLF is moving today based on hard assets, protected supply chains, and immediate tangible profitability. This tariff news, or whatever the specific catalyst is, lands in a very specific macroeconomic environment. Automotive demand, CLF's cash cow business, has remained surprisingly firm. At the same time, the big infrastructure spending bills passed over the last couple of years are finally turning into actual orders for beams, plates, and rebar. CLF is standing at the intersection of these two huge demand drivers, and the government just potentially locked the door against its foreign competitors. It's a perfect storm for profitability. This spike is also a validation of what the company's management has been saying for quarters. In their last earnings call, they likely guided for higher contract prices and better cost controls, and the market probably dismissed it as optimistic chatter. Today, the market is realizing it wasn't chatter, it was a forecast. The company has genuine pricing power. This is why investment help is so crucial. You can't just look at a chart on the Robinhood stock trading platform. You have to understand why the company is moving. You need to use the research tools available through Fidelity or SoFi Investing to understand the fundamentals. This is what separates a blind gamble from a calculated investment. The ability to research this, perhaps on the Fidelity trading platform or through interactive brokers, is what sophisticated investors add an edge. So, for those who are new to the story, what does Cleveland Cliffs actually do? This is the most important part. The market expectation is that they're just another steel mill. The reality is that they are North America's largest flat-rolled steel producer, but more critically, they are completely vertically integrated. They own the mines in Michigan and Minnesota that produce iron ore pellets. They transport those pellets themselves. They then feed those pellets into their own blast furnaces and, increasingly, their more modern electric arc furnaces. They control the entire process, from the raw material in the ground to the finished rolled steel coil shipped to a car manufacturer. Why does this matter? When global iron ore prices spike, it doesn't hurt CLF nearly as much as its competitors. They own their own supply. When steel prices rise, as they are now, all of that additional profit drops straight to their bottom line. They are insulated from the supply chain volatility that crushes other manufacturers. That is their moat. That's why an institution managing Fidelity ETFs or other large funds might be looking at this 21% move and deciding to build a core position. Now let's turn to the future outlook, because this is where the expectation versus reality framework becomes critical. The expectation from many traders is, okay, fine, it spiked 21%. It'll give it all back in a week when the tariff hype fades and the auto cycle inevitably turns. This is the classic trap for the self-investing crowd, reacting to the peak of the volatility. But the reality could be very different. The bull case is that the market is only just beginning to price in this new paradigm. If these new trade protections are real and durable, and if CLF management maintains its famous capital discipline, meaning they use this cash flow to pay down debt and reward shareholders rather than building expensive new mills, the free cash flow this company could generate over the next few years could be astronomical. This 21% pop might not be the end. It might be the start of a sustained re-rating from a cyclical commodity stock to a high-margin industrial powerhouse. People looking for online investment opportunities might be re-evaluating the entire sector. Services like Schwab Intelligent Portfolios may need to adjust their algorithms for the materials sector based on this new reality. This is a big deal. Of course, there are significant risks. What could go wrong? Two main things. First, a deep, painful global recession. Steel is, at its heart, a cyclical business. If auto sales fall off a cliff and all construction projects are halted, CLF will get hurt, tariffs or not. Second, political risk. A new administration could reverse these trade policies, reopening the floodgates to cheap imports and destroying CLF's pricing power overnight. This is why you can't just set it and forget it, even with automated investing sites. An individual brokerage account, whether it's with Fidelity, SoFi, or Interactive Brokers, requires active monitoring when you're dealing with a stock this tied to policy. The SoFi trading platform and Fidelity brokerage services offer research, but the decision remains with the investor. Even if you're just trading Robinhood fractional shares of CLF, you need to be aware of the macro risks. The next major catalyst will be the company's next earnings report. Will management officially raise their full-year guidance based on this new protected pricing environment? Will they announce an accelerated share buyback or a special dividend? What they say and do next will signal their confidence in whether this 21% spike is a temporary event or the new normal. This is a massive, decisive move. I want to know what all of you are doing with this information. Comment below if you are buying this 21% spike, if you're taking